And a particularly warm welcome, of course, to our guest speaker, Steve Keen. I guess he's known to most of you. He's quite famous these days. He has written this book that we all know about, Debunking Economics. But he is also one of the few economists, I guess, that to anticipate, that to warn about the crisis, and that well in advance of when it happened. You bet. It was in 2005.
2005.
Yeah. And the reason for that, I guess, had something to do with the model framework that he developed.
That's
that was
right.
based on the ideas of Hyman Minsky and his financial instability hypothesis.
Yeah.
And that's why we have invited you here, of course, because we wanted to learn more about this kind of Minsky framework. But before you start, Trond, he told me that he wanted to say a couple of words. So
I'll speak English, so you can correct me if I'm saying something wrong. Steve is my old friend from 1996. We met in Paris, I think.
Romantic start.
And I'm an engineer, he's an economist, but we discovered that we thought alike about economics. It must be dynamic. It must be described by dynamic models. And we have been off and on all the time. And lately, Steve also has been a consultant to the sort of left social democratic government of Ecuador. We have both been in Quito recently. And they are now having a very nice policy that is the best of what the Norwegian Labour Party did in the 50s and 60s. And they are completely open to the type of heretic economics that Steve does. And it's a government that's populated by very young people. The Vice Minister for Development is 29 years old. And so it's very refreshing to meet people that think outside the box and want to hear heretics from Australia. Anyway, so just one thing, Steve, I'm saying it again.
Yeah.
Speak slowly. I'm allowed to sort of raise my hand and say, Steve, reduce the tempo.
He's my speed fascist. Believe me, I need one. My Australian students tell me to slow down.
Yeah. Anyway.
Okay, well, thank you very much for the invitation. And I'm going to be, since I'm talking to statisticians, I imagine there are a few economists in the audience. Am I correct? Okay. Well, an economist is famously known as somebody who will say after they see something in the data saying, oh yes, but does it work in theory? So I'm going to start with the data that has really been why I identified the crisis. Of course, there's a theory behind it as well, which contradicts the mainstream theory. But the mainstream theory, and this is a quote from Ben Bernanke, explaining why he said economists didn't take Irving Fisher's debt deflation theory of the Great Depression seriously. He reworked it into an asymmetric information argument in his own book. But this is his reason. Pure redistributions, which is what debt is seen as, should have no effect. So let's not look at the data. And this is the data. The red line is change in debt, annual change in private debt. The blue line is unemployment. Correlation between those two variables over the last 14 years, roughly, minus 0.95. Let's ignore it. Theory says it shouldn't matter. Now, of course, we can see a boom occurring while the debt levels were rising. And what I was saying myself was I expected the opposite to happen when they started to fall. And now we're going through what looks like a recovery, but it's pretty tepid compared to previous recoveries. It's clearly recognised that we're not seeing the standard behaviour of the economy. But let's ignore that because the theory doesn't support it. Also, let's also ignore the fact that this is the first time since 1945 that private debt actually fell. Okay? Between those 2-year period. The dotted line there is zero change. So anything with the red line below the dotted line is where the level of private debt is actually falling in numerical terms. Not just as a ratio to GDP, but falling literally. And also, of course, conventional theory has still got the efficient markets hypothesis. I checked with students yesterday at the NTNU. They're still learning the efficient markets hypothesis. And that, of course, teaches that there's no relationship between the level of debt or any debt variable and the value of asset prices. So we can ignore this correlation as well. This is looking at the correlation of a second differential, effectively, not an approximated, the second differential of debt to the first differential of asset prices. Now, I didn't actually first do the statistic. It was done by a guy called Michael Beggs and Peck and a couple of others. I always want to acknowledge Michael for beating me here because he had the courage to check it out. I knew this was likely, but I didn't believe the stats would support it. When I saw this correlation, my jaw just hit the floor. 0.84 over that period of time. But let's ignore it because theory tells us it shouldn't matter. And then now we're getting a recovery going on. We had a slump, and you can see where the level of debt slumped, and the private debt is the one that I worry about. The blue line is the one that politicians know is far more important. Okay? That's what they obsess about, getting the government debt under control, not realising it's a symptom of the change in private debt. But now that private debt's rising again, a form of recovery is taking place around a lot of the Western economies. No problem with that. What's wrong with rising private debt? And of course you can ignore the long-term trend. So this is all the sort of stuff that conventional theory blocks out completely. I have been effectively going hoarse saying, for God's sake, look at the data and then tell me my theories don't matter. After that, this is why I'm appealing to statisticians first off with the data. So clearly, and of course you add those two trends together, there's a tendency over the last 2 centuries for rising total debt. I see private debt as far more important, but nonetheless the combination is still there. So we have something endemic in capitalism we need to be very careful about. Now, of course, mainstream theory ignores all that, and this is expanding on Bernanke's statement as to why he ignored Fisher in Bernanke's book called Essays on the Great Depression. And his argument was that unless there's enormously big differences between the consumption propensities of borrowers and lenders, then a distribution between the two shouldn't have any effect at the macroeconomic level. That's the conventional perspective. And this is Paul Krugman, who often criticises Bernanke, but in this case coming out with exactly the same argument, saying that, now when you take careful notice of the first line, when debt is rising, it's not the economy as a whole borrowing more money. In other words, there's no change in the amount of money in the economy, according to his theory. It's simply less patient people borrowing from more patient people. A little aside there, by the way, economists are so used to using words like perfect, okay, and equilibrium and so on, they don't see the pejorative content of those words. Don't you think patient people are better than impatient people? Okay. Now he goes on to talk about banks and saying that he's been fighting this rearguard action, well, front line action against people like myself will say banking essentially changes the nature of lending. When you say it's from banks to non-banks rather than from individuals, it's essentially different. And he refers to a paper from Tobin and then says that in this discussion, yes, commercial banks, unlike other financial intermediaries, can make a loan simply by crediting the borrower with new deposits. So he's admitting something which my side of economics has been saying for a long time. But he said that doesn't matter because the money just disappears out of the banking system effectively. So you can ignore banks. So that's the conventional picture that I'm opposing. So they ignore banks, debt and money. And even when Krugman started developing his liquidity trap argument, that was an argument about the debt mattering in a specific environment where for some reason, and literally that's a quote, for some reason, we have fallen to the level where the equilibrium rate of interest that would give you full employment is negative. And therefore you can't make up for the drop in demand by people who used to be borrowers by having savers dis-saving because you can't make the rate negative. So that's the one time he says debt actually matters. So but he's igniting here, and again I find whenever I find neoclassical economists, they will always say, oh, but you haven't read XYZ's paper in the Journal of Toe Cutting, from Tajikistan in 1732, where we covered that point. And I'm always getting that. So I like to choose quotes from conventional economists that point out that leaving banks, debt and money out of macroeconomic models is the standard practice. You may find the occasional neoclassical exception that attempts to include them, but they're normally completely abstracted from. And the model that is used instead is the idea of loanable funds. And I certainly became aware of how dominant this was in central banks when I gave a talk to the central bank and the Treasury of New Zealand. I just found I could not get past this barrier of seeing lending as being about loanable funds. And this is Egerton and Krugman talking about how they bring in debt, but not money and not banks in this particular paper, by presuming impatient agents borrowing from patient agents. Well, my alternative model, and I'm not the only person by a long shot who works in this area, but we are the minority. But we're only the minority today, and that's saying that from an endogenous money point of view, banks are crucial. I want to quote somebody to you making this case. It's saying that they, meaning business people's borrowing from banks, are different. Businessmen are able to achieve extra borrowings because the banks can expand. If the higher interest, they can expand the ratio between reserves and liabilities or let the ratio decrease, and therefore add additional spending power over and beyond what you can get out of just circulating existing deposits. Okay. Now, who do you think might have said that? This is Arthur Cecil Pigou. Okay. So I'm talking somebody who Keynes made his conservative foil in the general theory, to write it in throughout the book, even though they were friends, believe it or not. And this was conventional behaviour and conventional understanding back then. So something has been taken out of economics for this to no longer be accepted. So as I say, I'm far from the only person, and I'm certainly not a total out of the blue. This was in the literature quite strongly until the post-war period, that money is endogenous and banks matter. So what I want to do now is contrast the two visions, because I have to show, I find to break through the barrier of people thinking in loanable funds, I need to show what are the differences between it and endogenous money in a compatible framework. And I've recently designed an open source modelling software program called Minsky, for obvious reasons. And its intention is to enable economists to do system dynamic analysis, the sort of stuff that Trine Andresen and engineers do all the time. And there are many programs that do this already. Simulink is the dominant one in the industry, owned by a company called MATLAB. I mentioned there's quite a few MATLAB users here. Okay. But there's Mathematica has a version called System Modeler. There's VisSim, BenSim, I think, Stellar, etc., etc. What they don't have is an easy way to model financial flows. And the reason financial flows are challenging to build on these models is that if you make a transaction from financial accounts, you necessarily affect two different system states. The account from which the money comes, the account to which the money goes. You must affect them both, and you also have to have the signs right. Now that's possible if you really work really hard. You can do it using the flowchart paradigm, but it's complicated, messy, and people who try it normally give up. It just becomes too complicated. So I've added a double entry bookkeeping vision thing I call a Godley table named after Wynne Godley. And that has assets and liabilities and equity, the classic accounting framework. Assets are shown as a positive, and liabilities and equity are shown as negatives. And the source of any transfer is a positive, and the destination is a negative. That works consistently. It's actually a mapping of the accounting convention of debits and credits, but I find, any accountants here? I didn't study accounting, and I just find their debit and credit stuff just, my eyes pop out after a while. So I prefer them plus and minus, but you can actually take any model I show you and click a preference button, and you'll then see it debit and credit style as accountants expected. So I'm going to model loanable funds using Minsky and have a patient agent lending to an impatient agent, but I'm going to make them both capitalists. And then, of course, they're going to hire workers, produce output, and sell it to workers and bankers. And banks will be mere intermediaries. Banks are where the money is stored, but they have no active part in the system. And this is pretty much the neoclassical perspective. When all they do really is store the money the patient agent has deposited. That's all they do. They simply store it there. So this is the Godley, the Minsky interface, and I have three banking icons there. The big one on the left is the bank. The top one is the patient agent, and the bottom one is the impatient agent, showing the interlocking accounts there. And if I open up the bank block, that's what I see. Unfortunately, this is a small auditorium, so I think most of you can see what's going on here. So I have an initial condition that the patient agent has deposited $100 million or $100 in the bank and already lent 10 of them out with the impatient agent. And then there's a flow of lending between the two. So from the patient agent to the impatient agent then pays interest, repays the loan as well. The patient agent hires workers, the impatient agent hires workers, the impatient agent consumes, the patient agent consumes, workers consume from patient, workers consume from impatient, and bankers consume from the two as well. Now, is that fairly clear? Okay. That would be horrific in a flowchart or a set of equations. I'll show you what the equation looked like in a moment. That's why I invented Minsky, taking inspiration from Wynne Godley's work to make it possible to have a simple interface to understand this. And if you wanted to whack in 4 or 5 or 6 extra sets of columns, you can do it. And the extra rows is easy as well. So it's a very intuitive, simple interface for designing a model like that. Well, let's look at patient and the inpatient accounts now. So the patient agent has 2 assets: the deposit in the banking system and the loan made to the inpatient agent. And of course the net worth is the gap between the two. And oh, by the way, one thing I haven't pointed out, the program ensures you get everything right by making sure the row sums to 0. Okay, if you make a mistake there, it identifies it for you so you can see any problems. So here's exactly the same situation seen from the patient agent's point of view. And for the inpatient agent, has one asset, which is their deposit in the bank, but also, of course, the liability to the patient agent. So that's looking at the overall pattern. That's the interlocking system. Now, when I generate the equations, and Minsky generates the equations of a model in LaTeX. So if you wanted to document what you've done, you simply choose LaTeX and you'll have this output turn up. Now, this is what Sean introduced me to this term a long time ago, and I think it's a great term. You are now all suffering what's called the Migo effect. My eyes glaze over. Okay? But the table I showed you what generated those equations. It's the rates of change of each of the accounts. Now, if you look at those 4 accounts, patient plus inpatient plus workers plus net worth of the bank, that is the sum of the total amount of money in the economy. If you look at all the flows and see what happens to them, they all sum to 0 because they all cancel out. For every positive entry there, you can find a matching negative, and therefore the amount of money is conserved. And in terms of this dynamic systems paradigm that I work in, that's called a conservative system for obvious reasons. In this case, the amount of money is conserved. So if you go through and check out and see what your various terms are, ultimately they all cancel. So the rate of change is 0. Therefore, it's not a case that the people borrowing more money. Krugman's vision there. And secondly, the first 2 rows, patient plus inpatient, that's the amount of money in the firm sector. Now, if you think about the firm sector being where production occurs and where demand is manifest, the turnover of those 2 accounts is GDP. Okay? Now, looking at that, looking at the lending, repayment and interest play no role there, because if we get rid of those cancellations and now see what happens with interest, just interest repayment and loans, there's those 3 all cancel out within the firm sector. So there's no impact upon GDP of lending. Now, how does endogenous money differ? Well, if I had lots of time, I'd actually do this live, because I can change from the model of loanable funds to endogenous money with about 6 or 7 operations. And I just realised I've made the mistake again of not including sound here. I doubt that I can get away with it. I'll try to talk this through. Let's see how we go, because I've made a little movie of it. So there's the interface. That's the end model I want to get to. And I've done a little simulation here. I'll see how this works. Pardon me, just see if I can actually make the sound might be loud enough to actually be heard. Oh, that's, pardon me, I blew that.
Let's take this model of loanable funds and turn it into
I'll talk over the top of myself here because that isn't loud enough to hear. Just hang on a second and I'll change the sound level, just turn the sound off there. Ah, press the wrong button, Steve, why don't you? Okay, here we go, back to here. Okay. Okay, so what I do in this little movie here is first of all open up the patient agent's account, and you see I've got the loan there. Well, I can hit the delete key at the top of the column and delete that entry, which now means I've got to get some elements rebalanced because I've got rid of 10 of the assets of the patient agent. For example, I've got to compensate for that, and I've got lending and repayment shown in here. They're not getting lending and repayment flows anymore. It's going to the bank. So I knock those off, and that's why I'm getting correct there. This is making the initial conditions correct. So then they put 90 into the as a deposit into the bank, and the bank has made a load of 10 to the patient agent. That's just getting all the numbers rebalanced properly. And then come across to the bank, and of course the loan is actually an asset of the bank. So they come across to the plus column over here, the top above Well, first of all, I'm changing the amount in the reserves there to 90 to make that row balance. Just making it possible for you to see the whole screen there. I find grabbing hold of things with masks really be painful sometimes. Okay, plus on that column there, click the drop-down menu and choose loans, and instantly it puts the transactions in the right place for me. So I've now said the loan is an asset of the bank, not of the patient agent. So having done that, there's a bit more tidying up to go. The interest, I move the interest across as being a payment from patient to the bank, not patient to impatient. And then I have to do one more amendment, I think, for the patient agent's account, but they were still shown as getting interest. That's what's going on there. So having done all that, I then find myself with a model of endogenous money. It's just as simple to say lending is on the asset side of the bank ledger. That's all it comes down to. That's the difference in the vision. So once I do that, same sort of equations appear to be here. Same sort of story. The first four are the sum of the amount of money in the economy, but they don't sum to zero anymore. If I do that same thing with cancellation, I find the amount of money is not conserved. We've gone from what's called a conservative system in dynamic systems parlance to a dissipative system, where there's nothing actually being conserved. Things can grow or fall. Dissipative implies shrinking, but a dissipative system means one which can change in size. And if you look at the cancellations and see what's left over, where money is in the system, what's left is lending minus repayment. Okay? Now if you look again at the firm sector, lending and repayment and interest don't cancel out either. So if I just look now just at lending and repayment, there they are, matching down the bottom here. So the expansion of assets on one side is a dissipative system. The expansion of liabilities on the other side is a dissipative system. Put them together, you've got a conservative system. You get the overall assets equals liabilities plus equity, and demand equals incomes, and so on. But they can grow interdependently at the same time. So that's the essential thing we're missing out on in conventional economics, one of the many essential things we're missing out on. Now if I simulate the two models, if I run a simulation of loanable funds, then I can change, and I'll just bring this up and show you Minsky running now. Come on, have it loaded, let's see. Click for the third time. If it doesn't turn up, I'll just talk to the graph there. I've made lots of variations in the lending and borrowing parameter, lending and repayment parameters, and nothing has happened to GDP. The GDP is the horizontal line down here. Now the loans have been all over the place, but no impact upon GDP, which is the standard neoclassical macro. We can ignore banks, debt and money. At last, finally the whole thing wakes up, and I've got 3 copies. Just get rid of one of them. Okay. So if I and I've also unfortunately brought down an EDDX I didn't want there, but I've got rid of that, I hope. Let's see, what have I got here? Let's get rid of that one. Okay. And PowerPoint's objecting as well. Okay. So I simulate this now, and I then change the lending parameters. And I'm not sure why that's not reacting properly. Pardon me. Great. I'll come back to that one later. Okay, but I made dramatic variations, as you can see in the picture I've captured there, to lending and repayment rates. Huge changes to debt, changes to the amount of money in the two accounts, no effect on the macroeconomy. And therefore you can ignore banks, debt and money. But endogenous money, if I do the same thing, that's the sort of change I get. Because changing the amount of lending and repayment changes the amount of money in the economy, adds to demand in the economy at the same time, and you get both GDP and debt changing at the same time. So in that situation, the level of money is essential. I'll see if I can actually get this one to come up properly. Let's see. And make it a bit smaller so you can see it on screen properly. Okay, and simulate this, and then if I make lending much slower, or lending much faster, then I vary the economy quite dramatically, and equally by changing repayment rates much lower repayment, much faster repayment, etc., etc. And that, I say, is fundamentally the dynamic we saw in the real economy, which, of course, conventional theory had us ignore. So you have to include banks, debt and money in capitalism, and you've got to include it in your statistics as well, which is what I'm going to go on to in a moment. And that is, let's now look at this way we define aggregate demand and aggregate expenditure, but from an endogenous money point of view, where changing levels of debt do not mean somebody else's offsetting spending is reduced. Okay? An increase in debt means an increase in spending. So your own individual situation, in other words, scales up. You're spending in some of your income plus your change in debt. Now, because you don't have that patient to impatient dynamic, it means that does scale, it does aggregate. So I can say that income is wages plus profits, and divide profits into distributed profits and retained earnings, and then look at expenditure, and leaving out government and asset markets for the moment, you'll either spend on consumer goods or capital goods, so expenditure will be C plus I. But there's two sources of demand for consumer goods, workers and capitalists, but in both cases they can borrow money to buy those goods. Now that can be positive or negative, up or down, as we've seen in the real world. And that is therefore your demand is not just the income, it's income plus the change in debt. Ditto for capitalists. And looking at investment, two sources of income, of expenditure there. Retained earnings or new debt. And same sort of story, that can be positive or negative. Normally positive. So you put the two equations together, there's your expenditure equation, and expand out what actually finances them. Rearrange and subtract income. I know I'm going. I know I've got to, but I just want to show the cancellations here. So your expenditure minus income will be the change in debt, and that also includes asset markets when you look at those and the role of the government sector as well. So we have to redefine our macroeconomic identities, and I can see some querulous looks in the audience because it looks like double counting to a lot of people. Okay. And that's not just neoclassicals, I get that from my own side of economics as well. And I think there's several reasons for this, but one is we tend always to fall back into ex-ante thinking in economics. When Keynes talked about the importance of ex-post and ex-post, after the event recorded. But what matters in economics, what drives it, is ex-ante, before the event. Where do you get the money from? Why do you make the decisions, and so on? So a conventional thinking tends to fall back into being ex-post. And you compare recorded expenditure and recorded income, and that will include, the recorded income will include the impact of change in debt. Do your recording, you'll find them identical. But in one way which is going on, to think about this happening, and this is still tentative, still working on trying to get the logic exactly right, but if you imagine expenditure on a daily basis running at $1 billion per day, and then at some point D, in the middle of the day, somebody takes out a large loan, $100 million. There's your change in debt. And then from that point on, once that money's been borrowed into the economy, it continues to circulate as income to the person from whom something has been purchased. So there's your income ex ante. There's your change in debt. And there's your expenditure at time D, sum of the two. Now if you measure it, your recorded income and your recorded expenditure are going to be identical at that point. And if you think of measurement here, integrating the area beneath that line, so if I go from 3 hours before to 3 hours after, I'm going to get a value of 262.5 million for that time period. If I chose a different 6-hour slot, like before, I would have got 250. After, I'd get 275. Okay? There's a discontinuity at that particular point. Okay? Recorded expenditure and income are identical at all points except when the money is borrowed into existence. And if you look at that in terms of a set of equations, then before time D, income is running at $1 billion a day. Expenditure is also running at $1 billion. At time D, income is still $1 billion, expenditure is 1.1 billion. It's the billion at that point of income plus the change in debt. And then after that, they're again equal to each other. So we're letting it slip through that discontinuity in effect. So expenditure is income before an injection of debt plus the injection of debt. And then it means that's where I get some of the results that I showed you beforehand. When I look at the role of change of debt and compare it to economic indicators, I get massively strong correlations that according to conventional theory, I should have no effect. There's something we have to investigate here in great detail. So I've been accused of using a lot of jargon and inventing jargon, and here's another one. I think Volra deserves some credit for trying to get us to think about an accounting balance and multi-sectoral dynamics. But Schumpeter and Minsky took us further than that by saying you've got to have a monetary vision of the economy, and in that monetary vision, expenditure will be greater than income. And you'll find that in both, Schumpeter, Minsky, Pigou, quite a range of people, Fisher, that is the situation. I'm now trying to formalise it. But equally, demand is both income and change in debt. Supply is goods and services, but also turnover in asset markets. And most borrowed money these days is actually used to finance asset speculation, unfortunately, rather than production or consumption. So looking at that in a very generic way, I'll say on one side I have income plus change in debt, on the other I've got GDP plus turnover on the asset markets. And I can break that down into the price level of assets times the quantity in existence times the percentage of the fraction that turns over in some time period. Now, this has strong implications for both macroeconomics and finance. For a start, change in debt is going to be a factor in employment and output, etc., as I've shown you with those early graphs. That's the change in debt to economic activity relationship. But if you look at the rate of change of demand, then you're going to get a relationship between the acceleration of debt and the rate of change of asset prices. That's again why I've got my own take on what's happening in Norway's housing, which I'll explain in a moment. So that change in debt explains the crisis and also the great moderation. They're both matching phenomena. And the fact that accelerating, from this point of view, the proposition that accelerating debt is needed for rising asset markets is an obvious reason why asset bubbles eventually burst. Nothing can accelerate forever. But all this stuff is still absent from macro, and a major reason why is the obsession with what's called micro foundations. So I want to address this because one thing I find quite tragic about economics is that economists are very ignorant of their own literature. And I don't just mean neoclassical economists are ignorant of the sort of work that I do. That's bleedingly obvious. They're ignorant of the work their own colleagues do, because they simply assume somebody else has proven this works, I'm going to use it. What's actually happened, somebody else has proven it doesn't work, and they still use it. So I want to illustrate that. And this is one of America's most prominent economists and very aggressive in how he defends neoclassical economics, a guy called V.V. Chari. And he was one of 5 people invited to speak to a congressional hearing about economic theory back in 2010. Okay. And there he is before it's saying, from this perspective, DSGE, dynamic, stochastic, general equilibrium models, the very big tent, talk about all the things they include. He said, and there's no other game in town. It's the only way you can do macroeconomics. He said, a useful aphorism, if you have an interesting story to tell, you can tell it in the DSG model. If you cannot, your story is incoherent. Another person invited to exactly the same hearing was Nobel Prize winner Robert Solow. What did he have to say about DSG models? He said, well, I insist that everything has to pass the smell test. I think Robert's nose has improved with quality over time. I think a lot of what he did in the early days didn't pass the smell test, but he was also fighting with Joan Robinson, who's a very difficult human being, so I can understand his attitude here. But here he's saying, does DSGE modelling pass the smell test? He says, no, it doesn't. Now, one reason Solow is so essential is that DSGE models are built on his growth model. Okay? Not like any random neoclassical economist. This is the person combined with Ramsey, whose models were the foundation of real business cycle models. So he knows what he's talking about, and he knows what he thinks about it, saying it's nonsense. He said, they take it for granted. Now, he's now talking about neoclassical economists in the third person. Not we anymore, it's they. Okay? They take it for granted the whole economy can be thought about as if it were a single consistent planning person or dynasty carrying out a rationally designed long-term plan occasionally disturbed by shocks but adapting them in a rational way. He said that doesn't pass the smell test. And he said the protagonist, and V.V. Chari was in the room at the time, obviously a protagonist, have a claim to respectability, asserting this is based on what we know about macroeconomic behaviour. But he said that's phony. And I'll show you just how phony in a moment. He said they seem to believe it, but they've either stopped sniffing or they've got no sense of smell. And I agree with Solo completely there. What he was talking about, the reason it stinks, is a thing called the Sonnenschein-Mantel-de-Breuer theorem. Now, have anybody heard of that before? One? Whoa, anybody else? A few? Good. Okay. That economists, even the people who did this, I think, have misinterpreted its implications. But effectively what they did, they took a model where you assumed the entire economy consisted of agents who all had downward sloping demand curves. And the question is, when you add them up, what do you get? And the answer is, you get a market demand curve that can be described by any polynomial at all. In other words, any shape you like that doesn't double back on itself and doesn't cross itself. That's what's legitimate, according to the theory. That's not at all what people who use DSGE models think is the case. Now, this is the Sonnenschein-Mantel-de-Breuer, or the Sonnenschein paper. We prove every polynomial, no restrictions, every polynomial is a demand function for some economy, some commodity in some end commodity economy. So every real valued continuous function. So much for a downward sloping line. Okay? Now, Kerman had the one truly sensible reaction from a neoclassical point of view to this, and he said, if that's the case, maybe we can't work at the level of the isolated individual. Maybe we have to move back to modelling at some level of aggregation and abandon the individual as a foundation of the theory. That is pretty much saying we should return to what the classical school of economics used to do. Workers, capitalists, bankers, rentiers, etc., etc. But at least there's reason to aggregate capitalists together and aggregate workers together and talk about their collective behaviour. But to work at individuals, no, you can't do it. So quality neoclassical research has proven that DSGE models can't work, and yet they dominate treasuries, reserve banks, and most academic departments around the world. And this is, again, even when they get taught it in textbooks, I'm sure the teachers don't use this particular section of Mas-Kalel. Mas-Kalel actually points out this is the case. Okay? So to be ignorant, there's no excuse for being ignorant of this literature. It's even in the most dominant neoclassical textbook. And what this proves is you can't derive macro from micro. Now that's a common result in all sciences of what's called emergent properties. And there's a wonderful paper I highly recommend reading. You can download it from the web. Just search for More is Different. And in that paper, Philip Anderson says that back in the 60s, physicists realised that behaviour of large aggregations cannot be reduced to what happens at the individual level. You can't make biology into applied physics, for example. He said new levels of complexity apply at each level. And my favourite instance of this is, if economists were doing the right thing by reducing macro to micro, and that applied in general across sciences, then a typical question in a biology exam would, please take these chemicals and make life. Okay? It's a fallacy to believe you can do that, let alone that you have to do it. So he said there is a ranking of sciences, but it doesn't mean that science X is just applied Y, science Y the one below. There's new rules at all levels. So macroeconomics needs to be is a distinct discipline in that sense. You can't reduce macroeconomics to applied micro. It's a fallacy even to believe you should, let alone that you can. And equally what's being done there is actually what Anderson identified as constructionism, saying that not only do you reduce to the lower level, but you must build the upper one from the lower. Again, what economists are doing with micro. And again, he said that simply doesn't apply. He said even if there is a hierarchy, even if it is true, for example, that economics has to be based on accounting, which I say it does, okay, you still can't reduce economics to applied accounting. And I think some of the difficulties I'm having in communicating my point to some critics on my own side of economics come partly from that. You must obey what's happening in accounting, but you don't reduce it to all that you know about accounting. So you can't work backwards. You've got to start at the appropriate level, and macro needs to become again an independent discipline. And the fact that it's not consistent with micro in the terms of you can't derive neoclassical micro results at the level of macro, great, because neoclassical micro is a load of nonsense. And they've proven it doesn't scale anyway. So here's Solo having another go. I just want to show one little quote here, or two little quotes. He said, talking about the same picture of the DSG model, how could anyone expect a sensible short to medium run macroeconomics to come out of that setup? This is the level of criticism that is being ignored by people who continue doing DSG modelling. And he also said, and this is very important from my point of view, he said the whole thing is fixated on equilibrium. As it happens, he gave this talk as a tribute to Joe Stiglitz. I think he gave it on the 13th floor of a building in Massachusetts Institute of Technology. He just looked out the window, 15th floor, where he's giving the talk. He said, if I dropped a ripe watermelon from this 15th floor building, he said, I imagine I could model the whole thing as a dynamic equilibrium. Said, that wouldn't be the most fruitful, way to describe the process. It's disequilibrium. The thing is falling. We need to work in disequilibrium as well. So we need an alternative macroeconomics. And my foundation for that, as I explained in other lectures, is Minsky's financial instability hypothesis. And that integrates a whole range of disequilibrium views from non-conventional economists, Marx, Schumpeter, Fisher and Keynes. And what I find one of the many novel things about Minsky's perspective is he sees capitalism as being unstable upwards. A lot of critics see it as being unstable downwards, stagnation, underconsumption, etc., etc. You know, he says the tendency to turn doing well into a speculative boom, that's the basic instability. And of course money and debt plays an essential role in that. And he sees capitalism as being inherently flawed. Okay, it has to have these flaws to function. So it can generate signals that lead to accelerating investment and finance that as well. All that tied together. So the basic hypothesis has an economy in historical time. Think of 1992-93 now, when the American economy is starting to recover from the 90s recession that brought Bill Clinton to power. And of course, you all know about the debt-induced recession of the recent past, the savings and loans crisis, the 87 stock market crash, etc., etc. And that means both firms and banks are conservative. This is not asymmetric information. This is shared pessimistic expectations about the future. Therefore, only conservative projects get put forward by firms to be funded by banks. But because the economy is recovered, most of those succeed. Some will fail, okay, but most succeed. And firms and banks think, oh, if we were riskier, we would have made more money. So the ratio of debt to equity starts to rise. And in Minsky's classic phrase, stability is destabilizing. Now, after a period of this for a while, you have euphoric, what he called the euphoric economy coming out. Not rational expectations, but euphoric expectations. And that's for a while self-fulfilling, because if you have a decline in risk aversion and you're having more investment, then the economy will grow faster, which validates that investment to some degree. But you start getting rising asset prices as well, so you can speculate on rising asset prices and make money that way as well. And the money supply expands, as I've shown you with the endogenous money case a moment ago. And you get riskier investments being allowed, more of which are going to fail. Okay, so there's more things which are failing here and need money to paper over their failures. And you then get emerging what he calls the Ponzi financiers. Now, Ponzi financiers are capitalists who have a cash flow from their investments that are less than their debt servicing costs. So technically, they're bankrupts. They only survive by selling assets on a rising market. But of course, until the asset is sold, they're losing money. So they've got to continuously borrow money to keep themselves going. They've got an insatiable demand for money. One of the most famous Ponzi's is in Australia, and a guy called Alan Bond. That ring any bells to you at all? Long, long time ago. He won the America's Cup. The yacht race we've just seen happen back in America recently. And he said the most important thing about that particular victory was it opened the door of every bank in the world. So they've got to borrow to service their costs before the asset sales. They drive up the cost of money to everybody. And of course, there is the profitability of asset speculation is reducing sensitivity to debt and interest rates to begin with, driving up the supply and demand of money, making market rates rise, and maybe the central bank dives in and thinks they can calm it down with tweaking the interest rate as well, ignoring the volume effects I'm talking about here. But a whole range of things are going wrong in the background. Ponzi's are losing money all the way through. If there happens to be one repayment where they can't get refinanced, they'll fold. But they're the most fragile people, even though they look like the richest and most powerful, they're the most fragile in the economy. Many of those euphoric investments will fail. Also need money to be papered over. And rising rates can make some actually well worked out projects look more speculative, which may force non-Ponzi investors to actually sell them to the asset markets, and all those factors together, the asset market bubble ends. The acceleration effect I showed you as well can't be maintained. So asset prices start to fall, and as soon as they do, the first ones to go are the Ponzi's, because they're already bankrupt. All it needs is somebody to say, no, you can't have a loan, and that's the end of them. Okay? And the asset prices collapse. Now we're talking 2000, by the way, of course. We've gone from the 1990s to the dot-com bubble and all that period. And think of all the ridiculous investments back in the dot-com bubble. Okay? The money supply expansion goes into reverse, economic growth slows down, and the economy is back where it started again in a debt-induced recession. So that's Minsky's verbal picture of how the economy operates. With high inflation, he argued that you can repay debts with a rising price level, which is what the 1970s were about. And of course, government spending also enables this to be recovered from, because the government provides a cash flow you wouldn't otherwise have during a downturn. So there are attenuating effects to the model and overall. But that's the verbal model. And what I've done in my modelling, and this is where Trun Andresen and I first met back in '95, so I built a model of that based on a cyclical model designed by a guy called Richard Goodwin, who's the leading non-linear dynamics person in economics. A name most of you would not know, but well worth getting acquainted with. And the model he actually built was a verbal model from Marx back in 1867. And if I simulate that in Minsky, this is not using the banking sector right now, then if you look at this model initially and look just at the employment rate, which is this chart here, then what you see going on appears to be a great moderation, diminishing cycles. But look what's happening to the debt ratio, which is over here. And now what's happening to your cycles, back over here. I'll just... okay. What you've got is a system going through a cyclical breakdown. And there happens to be a particular class of chaotic models known as the inverse tangent route to chaos. I had no idea about it when I built the model. I found out the mathematics later. But that is the basic idea of stability being destabilising. For simply adding in that firms borrow money to invest. And that's a potential instability you can get out of the economy that way. Now what I'm trying to build with Minsky is the capacity to do that with genuinely, explicitly monetary models. And this model is not complete. There's I haven't got stocks of unsold goods properly included in there, which I need to include to make the model properly stock flow consistent. But when I simulate this model, which includes a banking sector, I'm waiting for my other little movie. I might just jump past to bring up the actual program. Pardon me. Don't press buttons at the wrong time. Okay, let's go back and try that again. Now my trouble is I'm trying to click on that and it's exposed by the movie. What I'm showing here is I've got explicitly monetary model in the system. Financial flows between all the sectors like I showed you beforehand. So this is a genuinely monetary model. And when I simulate this model, hopefully my movie will go to that point now. Let's see. Okay. What you have is the breakdown that occurs this time is rather more like what we went through in 2005, 2008. That it looked like you're having diminishing cycles, so the great moderation is taking place. Then rather than, you've got rising debt over here, but rather than rising amplitude on the other side, you then get a collapse. Let's get rid of this. What's happening here? Okay. You get a crash, a unidirectional deflationary crash, which is the Great Depression type effect. So that's my overall perspective on economics. But we need a new way to do economics to get away from the neoclassical paradigm in a sensible way, because we can't afford to have ideology dominating how we try to analyse capitalism. That was for the 19th century. We've got to live in it, rather than let ourselves get caught with all these catastrophes and being surprised by them. So I want to build a monetary, non-equilibrium, multi-sectoral, dynamic way of modelling the economy. And the multi-sectoral side, I'm mentioning this because I've got a bit of a chat with Roger beforehand about what you do with your own model. I've already managed to do that in Mathematica. So this is a model of a hypothetical 4-sector economy where the system generates limit cycles, as you can see there. It gives me cycles and distribution of income, limit cycles there as well. The equations are fairly hairy. We're going to go a long way past these as time goes on, but I'm going to be producing a 3-dimensional version of this. So my Minsky software, when you create a one-dimensional model of the economy, you then tweak it and say how many sectors you want. 80 sectors, you've got the entire structure to handle an 80 or 105 sectoral model of the economy. That's the intention with Minsky further down the track. And then, of course, once you've got that properly specified, you've got a national economy, which you then, if you link that to other national economies, you then, with financial and trade flows, you've got a model of the globe. So what I'm trying to do effectively is to provide the same framework that Lorenz did decades ago for meteorology with his model of turbulent flow, and ultimately that is scaled to the level of the atmospheric models we now watch on TV every night, watching the weather forecasts, which are far more accurate than what happened 40 or 50 years ago when they used to largely rely upon linear techniques. Because I think ultimately continuing to model capitalism as though banks, debt and money don't exist is like continuing to model birds as though they don't have wings. Well, it'll be a tour de force to show they stay up in the air, but it wouldn't be realism. And we need to get to be realistic about economics. But just to conclude with the stats, what's going to happen from my point of view, what can I forecast forward, what we're seeing at the moment? We're going through a recovery, but it's not your usual recovery. This is looking at the acceleration of debt in America and the change in unemployment. And you can see the huge dip of the crisis itself, and now a recovery, but already the rate of acceleration of debt is declining. And a major reason for that is debt is still at unprecedented levels in historic terms. Even though it's fallen by 20% or so in America as a percentage of GDP, it's still about 20% above the peak that was reached during the Great Depression. So the room for acceleration is limited. And therefore, I think we're going to find ourselves doing what the Japanese did. Every time there's an apparent recovery, the government will then withdraw its stimulus and thinking everything's back to normal again, and you'll slump back down again. So I think the fate is turning Japanese, unless we recognise this and realise we simply have to reduce that level of private debt. And that, in my way of thinking, involves something like the ancients would have called the Jubilee. So what about your home country? What's going on here? Well, the Bank of International Settlements has thankfully produced a database that lets me compare a range of countries together. So you've got a higher level of private debt than America. The dotted line is America's aggregate private debt according to the BIS. The black line is yours. Mainly with business debt, as you can see. And I know you're having a discussion about whether you have a housing bubble or not. Well, let's just look at the acceleration of debt issue first of all. That's looking at acceleration of debt and unemployment change in America. You can see the strength of the correlation there. What's the story for Norway? It's there, but it's weaker, which to me implies your oil economy and your stronger industrial sector as well. And the reserves you've built up from the oil surpluses is a factor attenuating the impact of credit on your economy, even though you have a high level of private debt than America has. What about housing? Well, this is, again, the BIS has produced a series of house prices across countries. And on that basis, according to the BIS, real house prices have tripled in Norway in the last 20 years. So from that point, boy, you've got a bubble, okay? But what about cause? Well, it could have been, using oil wealth and things like that mattered. So let's take a look at America. We know America's a bubble now. Nobody disputes that anymore. So here's the relationship of accelerating household debt and the change in house prices in America, and I get a correlation of 0.7. What do I get for Norway? 0.75. Okay. Yeah, you took a bet. He owes you money. Good one. So I think you've got a bubble, mortgage-driven bubble in this country, and you have to do something about it. So, to conclude, statisticians measure what theoreticians tell them matter most of the time. And since neoclassical economists have ignored banks, debt and money, there's no systemic treatment of that in statistical systems around the world. It's been a real struggle for me to find data, and I'm so glad the BIS has finally come to the party with this database of debt and also a database of house prices. And we also don't collect data by social class, but according to the neoclassical theory, we should, to apply economic theory, work at a high level of aggregation. So things like this are needed. And the fact that we don't do it now is a bit like what happened before the Great Depression, when unemployment was regarded as being an individual failing. Okay? Where did you get unemployment data before the Great Depression? You went to trade unions and collected their data to see who of their workers was out of a job. After the Great Depression, we realised it wasn't the fault of the individual. Well, the same thing for here. We have to realise we need to think about debt and the behaviour of banks and money on a social class level to understand capitalism. The BIS has really helped out with those two data series. I'm delighted that's been done. That again reflects that the BIS had a guy called Bill White, who was a research director, who was about the only person who was knew Minsky and was a fan of Minsky's work in the high level in the formal hierarchy before the crash occurred. And Bill has told me he would give a paper at the bank. He was the research director at the Bank of International Settlements, and he'd give paper to Greenspan in the audience, and Greenspan would just stare him down and dare anybody else to follow up on what Bill had to say. But Bill had the courage to take him on, which I greatly admire him for. So we now know unemployment is a systemic issue, and the same thing applies to banks, debt and money. And I'd be delighted if statisticians beat economists to finding that out. Thank you.
Okay, we have 5 minutes for questions.
Sorry about the length. Yeah.
Every now and then I see like economic experts, both in Norway and abroad, which are very enthusiastic because the banks are lending more money again, and they're seeing that as a great sign of the economy. Isn't that really just, according to what you're saying here, isn't that just building another bubble?
Yeah, we can't get out of this crisis by getting back into what was an unsustainable trend beforehand, because looking at that level of private debt, I mean, we're now seeing a turnaround. This you can't quite tell on the graph with the fact that it goes for almost 200 years, but just at this point the ratio of debt to GDP is rising once more. Now, that is not the way out of the crisis. That is into another one further down the track. So I think what we're going to find is we will falter back into another downturn at some point, because the serviceability of that debt is ridiculous compared to what it was like back here. The reason the 1950s and 60s was such a golden time for American capitalism and industrial capitalism was they were carrying a trivial amount of debt. It had all been wiped out by, first of all, what happened during the Great Depression, but unfortunately, mainly, by the Second World War. So it's not a good thing. It's a sign of returning to the same unsustainable trend that caused the problem in the first place. Yeah.
What is the lesson for policymakers who draw from this?
Very, very good question. They've got to think more about private debt. And their obsession about public debt, as you can see from the chart I've got here, public debt only began to rise after the crisis. Okay? So rising public debt is a symptom of the cause, and the cause was first of all the private debt bubble beforehand that they did nothing about, they didn't think it mattered, and then private debt declining during the crisis. Now, what we need is to get private debt down. So that means we have to write off a lot of debt. Now, the attitude that a lot of policymakers have is, people, voluntarily took that debt on. The banking sector sells this stuff, and we treat the banking sector like a generally treat the banks as the same way we treat a doctor. The doctor says, take this drug, we say sure. The bank gives us cocaine. Yeah? We've actually taken a dangerous drug, and it's benefited the banking sector but not society. So we have to say on some occasions the banks can create too much debt, more than society needs, and they've always got an encouragement to produce more debt because that's how they largely profit, so they have to have that written off. Now that's been triply complicated by allowing all the derivatives to be invented and securitisation of loans. So my proposition is we need something I call a modern debt jubilee, where we use the government's capacity to create money, the central bank, and create the money directly into household accounts and business accounts on condition that if you're in debt, you must pay the debt down. Cancel the debt. Cancel that amount of money. But of course, savers who own bonds would suffer from that, but they also get the identical injection. So their loss in terms of the dropped value of the bonds and dropped income from bonds is compensated by the cash injection. And something like that would be a modern way of doing what the ancients used to do regularly, which every 50 years abolish the debt. That's not going to be our current policymakers who do anything like that, of course. Yeah. Yeah.
I'm not sure if you mentioned it. Have you ever tested the model with real data?
No, I haven't had a chance to do that yet. This is being a one-man show, and not totally a one-man show. There's plenty of people doing non-orthodox economics, the modern monetary theory group, and a whole range of people like Mark Lavoie and so on. But in terms of fitting it to data, I simply haven't had time. The next extension of Minsky is to include the capacity to import data and do fitting. But then we're talking nonlinear parameter estimation techniques and so on. So it isn't the usual linear regression work. But I do want to do that. And again, Minsky is an open source program. So if it gets developed, its capacity will be there for everybody to use. And I would hope to get some contributions of various types from around the world to make that possible. Yeah, you want to follow up? Yeah.
I'm not an economist, but is it really true that none of the neo-classical macroeconomists that include banks and money in the recent models?
The closest you've got is Paul Krugman, including debt, but not banks and not money. And what his debt was in riskless bonds in the consumption good. That's about as fancy as they've got. It's ludicrous, but that's how bad it is.
I'm going to accept one more question, and then we have to stop. Okay, please.
Do you think that this approach can contribute to build a bridge between macro and environmental economics?
Yeah, in fact, the next stop I'm making is to go down to Paris to work with Bob Ayres, who's one of the world's leading ecological economists and physicists, and he and I are working on a book on energy and economics together. What I want to include is the capacity to include the role of energy in making production possible, because without that there'd be nothing, let alone there wouldn't be life on the planet, let alone production, without free energy from the universe coming in. And secondly, of course, that gives you entropy, because again, production is a local reversal of the second law, which cannot be reversed, therefore we must be putting a load on the environment as well. But then at the other end, I've already done this with the data I showed you with the multi-sectoral model, was part of work with the United Nations Environment Programme, where they wanted to do a forecast for what was going to happen with resource availability in Southeast Asia. So my database gave the cyclical fluctuations in growth, which you couldn't get out of a neoclassical model, of course. That was fed into a database put together by what's called the CSIRO, the Commonwealth Scientific and Industrial Research Organisation. And that is a database that is like a multidimensional flow dynamic of the stocks and the flows in an economy. For example, one of the stocks they had with all the trees in Southeast Asia, but not just how many trees there were, what ages the trees were, and where they were located, and then what the usages were. So feeding my model into the system then meant they could say, well, here's the depletion this year, and then what's available for production the year after that, and so on. And the terrifying thing in that particular projection, everything was going along fantastically until 2038. And in 2038, according to the projection of the model, that's when Southeast Asia ran out of harvestable trees. Just like that. So both ends, in entropy, exergy, energy at one scale, and then at the other, resource depletion and tide all together. Yeah, definitely an ambition.
Okay. And okay, perhaps. Until the last one.
Yes, I was just wondering if all agents are using your
I'm
model.
sorry?
So if your model is right, and if all agents are using that model, so if your model can actually predict what's going to happen, if agents in the economy start using this, what would then happen?
I think we agents certainly react what other agents are doing, but nobody forward anticipates in the way neoclassical theory thinks is possible. What we tend to do is react to what currently matters to us and project that forward. And there's a whole area of expectations under uncertainty which is being ignored by neoclassical economics. So I think I might actually have to quote in another presentation I'm giving here about giving tonight, if I can actually find that particular slide, and just show you what the idea of forward-looking expectations was about in neoclassical theory. People don't often look and see where the hell did this thing come from. Let's see here. If I've got the right one. I may have jumped over it. But the point at which rational expectations came in, no, I can't find it, pardon me. No, I can't locate it. Sending a blind looking at the screen popping up there. When Lucas first brought rational expectations in, his argument for doing it was because the adaptive expectations hypothesis actually implied that the government was willing to accelerate the rate of growth of money every year to drive unemployment below the natural rate. And he said because the natural rate hypothesis can't be sustained by adaptive expectations, and what adaptive expectations mean is, your forecast for inflation is the previous value. He said, if we assume people can predict future inflation precisely accurately, or we assume rational expectations in the sense of Muth, then we can have the natural rate hypothesis that there's a fixed rate of unemployment the government can't vary. So he was willing to bring in an assumption that people can accurately predict the future. But rather than saying that's what we assume, he called it rational expectations. It's not rational, it's prophecy. So I'm not about to say that people can prophesize the future using any model, including mine.
Okay, and I want to say thank you to Steve for coming.
Thank you.